Sophia is here, and I have spent the last 5 years watching two very different versions of retirement take shape. Not mine yet, but the people I've studied, the investors I've followed, and the quiet mistakes I've seen repeat across tax returns and dinner table conversations. Two people can walk into retirement with the same number on paper, say $1.5 million, and walk out into completely different lives. One of them is sipping coffee in a small coastal town in Portugal, checking their phone once a day out of curiosity, not necessity. The other is on the phone with a contractor in Ohio, trying to figure out why the deck needs staining again and why the mountain cabin's pipe burst cost 4 months of rental income. Same net worth, same starting line, completely different trajectories. And the deeper I looked, the more I realized it wasn't about discipline or market timing. It was about what they chose to own. This distinction matters more right now than it has in years. We are sitting in an economic environment where inflation has proven stickier than most models predicted, where the Federal Reserve is navigating a narrow path between cooling demand and triggering a recession, and where the average investor is being pulled in multiple directions by conflicting advice. The market has rewarded patience over the last decade, but it has also masked a lot of structural weaknesses in how people build wealth. Weaknesses that only become visible when you stop looking at net worth and start looking at cash flow, liquidity, and carrying costs. That is the lens I want to use today. Not to tell you what to buy, but to walk through the 8 categories of assets that tend to drain wealth quietly over time. The ones that show up on balance sheets as assets but behave more like liabilities in real life. Let me start with the category that feels the most emotionally justified. A second home, a vacation property, or what the industry politely calls a lifestyle asset. You work hard for 25 years, you want a place that belongs to your family, a lake house, a mountain cabin, a small beach condo where everyone gathers for the holidays. That sounds less like a financial decision and more like a life decision. And that is exactly why it is dangerous. Because when emotion leads, math follows behind at a distance. Here is the reality that does not show up in the glossy photos. Property taxes do not stay flat. HOA fees trend upward. Maintenance is not a one-time event, it is a continuous drain. And unlike your primary residence, a vacation home rarely generates income unless you rent it out, which then turns it into an unpaid property management job. I have watched couples in their late 50s slowly realize that every long weekend they thought would be a break has become a maintenance trip. Cleaning gutters, winterizing pipes, vetting contractors, chasing down repair quotes. That is not retirement. That is a second career in facilities management with no salary and no HR department. The opportunity cost here is brutal. If you tie up $500,000 in a vacation property, that money is not working for you anywhere else. A simple, diversified portfolio with a conservative 7% annual return generates $35,000 per year in cash flow. That is not theoretical money. That is real liquidity. $35,000 buys a lot of travel, a lot of 5-star hotels, a lot of flexibility, and at no point do you need to call a plumber at 10 p.m. on a Saturday. That trade-off almost never appears on the brochure. Then there is the cousin of the vacation home, the timeshare. On paper, it looks like fractional ownership. In practice, it is a recurring liability with a contract stapled to it. The average annual maintenance fee for a timeshare has already crossed $1,400, and that number has no ceiling. It rises every year, often faster than inflation, and you cannot opt out without going through a legal process that ranges from difficult to nearly impossible. Most people discover too late that selling a timeshare at the price they need is not realistic. The secondary market is flooded with sellers trying to offload these contracts for $1 just to stop the annual bleed. That is not an asset. That is a subscription you cannot cancel. Here is where things get less obvious and more expensive. The financial products sold at kitchen tables, on golf courses, and after Sunday services. I used to believe that buying something from someone you have known for years was the safest possible move. A friend from church, a relative who works in insurance, a neighbor who has been in finance for decades. The logic feels sound. They have skin in the game, they care about your family, they would not steer you wrong. But here is the structural reality that has nothing to do with personal integrity. Large commissions reorganize priorities quietly. Not because the person selling is dishonest, but because the incentive structure does its job. And the contract they slide across the table, often 50 pages long, is what actually governs your financial future. Not the handshake, not the lunch, not the shared history. The two most common products sold in these settings are high-fee annuities and whole life insurance policies dressed up as retirement vehicles. The pitch is clean. guaranteed returns, tax-deferred growth, protection from market volatility. For a narrow set of circumstances, some of that is even true. But here is the mechanism that rarely gets explained at the kitchen table. Variable and indexed annuities typically carry internal fees between 3 and 4% per year. Sometimes more once you stack on mortality charges, rider fees, and sub-account expenses. If the stock market returns 8% in a given year, your effective return after fees lands somewhere around 4 or 5%. You hand back nearly half your upside before you ever see it, and that is before taxes. When you eventually withdraw from a non-qualified annuity, the gains are taxed as ordinary income, not as long-term capital gains. In the current tax structure, that difference is massive. Long-term capital gains max out at 20% for most high earners. Ordinary income tax can reach 37%. On a large payout, that gap does not just sting, it restructures the entire outcome. Add in surrender charges. Most annuity contracts lock your money up for 7 to 10 years. If you need liquidity early, penalties can run 7 to 10% of the total value in the first few years. I have seen this play out in real life. A healthy retiree moves a significant portion of savings into an annuity based on trusted advice. 2 years later, a medical situation changes everything. They need cash fast, only to discover that the money is not really accessible without giving a substantial piece back to the insurance company. That is not a market crash. That is a contract doing exactly what it was designed to do. Whole life insurance sold as a retirement vehicle follows a similar structural logic. The cash value grows slowly, the internal costs are high, and the returns consistently underperform what a low-cost index fund would have delivered over the same period. The insurance component is real, but if you need life insurance, term life is dramatically cheaper. The difference in premium can be invested in a simple brokerage account, and almost always leaves you better off. The wealthy retirees I have studied do not use permanent life insurance as an investment vehicle. They insure what needs to be insured, and they invest the rest in transparent, low-cost, liquid assets. Now, let me talk about the 3 categories that hide behind sophistication: high-yield bonds, structured products, and actively managed funds. High-yield bonds, which the industry used to call junk bonds before the rebranding, promise meaningfully higher interest payments in exchange for taking on more risk. In calm markets, that math works on paper. The problem is timing. High-yield bonds default at the worst possible moment, during economic contractions, when your other assets like stocks are already under pressure. You reach for extra yield, and the extra yield reaches back at exactly the wrong time. In retirement, a portfolio hit you cannot recover from is not a setback. It is a permanent reduction in your financial floor. Structured products are more complicated by design. These are engineered instruments, typically combinations of bonds and derivatives, sold with glossy illustrations and a lot of confidence. They promise market participation with downside protection. What the illustrations rarely emphasize are the fees embedded in the structure itself, the counterparty risk you are absorbing, and the liquidity constraints that make it difficult to exit if your circumstances change. Complexity in financial products almost always transfers value from the buyer to the builder. That is not an accident. It is the business model. Then there is the one that does the most quiet damage over time: actively managed funds. Let me run a simple number for you. Take a $2 million portfolio. An actively managed fund charging 1% per year in management fees costs you $20,000 annually before you have seen a single dollar of return. That fee does not shrink when markets are flat. It does not pause when the manager underperforms. It runs every single year, compounding in reverse against your balance. Over 20 years of retirement, that 1% fee differential does not cost you $400,000. It costs you significantly more once you account for the compounding returns you never received on the money that left your account each year. We are talking about numbers that would fund a decade of travel or buy a serious piece of real estate. And the performance does not justify the cost. According to the most recent SPIVA report, roughly 90% of actively managed funds fail to beat their benchmark index over a 15-year period. Not underperform slightly, fail to beat. The managers charging you for their expertise are, as a group, delivering results that a low-cost index fund would have matched or exceeded for a fraction of the price. The wealthy retirees who stay wealthy are not doing something exotic. They are doing something almost boring. Low-cost index funds, transparent fee structures, broad diversification, and tight control over what leaves their account every year. They stopped trying to beat the market and started focusing on not losing to their own cost structure. Here is the counterintuitive insight that took me years to fully understand. Liquidity is not a consolation prize for people who cannot afford real assets. Liquidity is the asset. It is what gives you the ability to move, to adapt, to say no to a bad situation without bleeding out in the process. The retirees who sleep well at night are not the ones with the most impressive portfolio names. They are the ones who can access their money when they need it. Income matters more than net worth on paper. A $2 million portfolio that generates reliable, accessible cash flow every month is worth more in real life than a $3 million portfolio locked inside illiquid contracts, high-fee structures, and properties that fight back. So what do you actually do if you recognize yourself in any of these categories? First, stop pretending a timeshare is an asset. It is a recurring liability. There are legitimate exit companies that specialize in timeshare deed transfers, not the predatory ones that charge $5,000 upfront and disappear, but licensed firms that work directly with the resort. The exit will not be clean. You likely will not recover what you paid. But stopping the annual maintenance fee bleed from compounding further is worth more than protecting your ego about the original purchase. For a vacation home or rental property that is draining more than it generates, run the real number, not the optimistic version. Take your gross rental income, subtract property taxes, insurance, HOA fees, average maintenance, vacancy rate, and the value of your own time. If what is left is less than 4% of the property's current market value, you are underperforming a basic index fund while doing actual labor. Selling feels like admitting something. I understand that. But redirecting trapped equity into a liquid, low-cost portfolio does not mean you failed. It means you finally put the money to work instead of the other way around. For annuities and whole life policies that are underperforming, there is a mechanism most people have never heard of: IRS Section 1035 exchange. Under Section 1035, you are legally allowed to transfer the value of an existing annuity or whole life insurance policy directly into a new contract with lower fees, better structure, and more transparency, without triggering a taxable event at the moment of transfer. The IRS does not treat it as a withdrawal. No immediate tax hit. No surrender penalty on the receiving end. This does not work in every situation, and the details matter. But if you are sitting inside a high-fee annuity right now, paying 3 to 4% annually on a contract that is locking you out of liquidity, a 1035 exchange into a low-cost immediate annuity or a fee-transparent variable annuity could meaningfully change what you assumed would come with any exit. Talk to a fee-only financial advisor about this, not someone on commission, someone whose only payment comes from you. For actively managed funds, the move is more straightforward. Check the expense ratio on everything you are holding. If it is above 50 basis points, ask why. If you cannot get a clear answer, that is the answer. Low-cost index funds, total market, S&P 500, international, charge between 10 and 30 basis points annually. The switch is not complicated. The tax implications of selling depend on your account type. But inside a 401k or an IRA, you can reallocate without a taxable event. Control what leaves your account. That is the whole game. I am not going to tell you any of this is easy. Unwinding a bad financial decision takes time, and sometimes it costs something on the way out. But the alternative is paying that cost every single year quietly while the compounding works against you. You can start reclaiming your cash flow this month. Not all of it, but some of it. And that is where it begins. The framework I have learned to trust is simpler than most people expect: liquidity, income, and cost control. Stop collecting complicated things that impress people at dinner parties. Start collecting options. The freedom to travel without checking whether a contractor called. The freedom to retire early if your health changes. The freedom to help your family without triggering a surrender fee first. That is what the right assets actually buy you. Not status, not a story. Just room to live the way you intended when you started saving in the first place. If this video helped you look at your own portfolio differently, subscribe to the channel. Tomorrow, we are going to keep pulling back the curtain on the financial truths that do not get talked about enough. See you then.